Welcome to the Property and Casualty Insurance Basics chapter. This is one of the most important chapters on your test. It's roughly 30 to 40% of your test. This chapter will be mainly definitions, and there's a lot of them. Almost every definition will be on every test. So what we recommend doing is getting a separate sheet of paper for you to take your important notes on. Important notes are things that people typically forget, and you might have to go back to those notes a little later on to refresh your memory. Since it's such an important chapter, we're just going to get started right away. The insurer is the insurance company. State Farm, Allstate, Farmers, Nationwide, Geico, pretty much any insurance company is known as an insurer. Sometimes you'll hear me say the word insurance carrier or carrier. That is an insurance company as well, just different terminology. The insured is the customer. That's who's buying insurance. I enunciate the D insured that way you know what I'm saying, but the correct way to say that is insured. You are trying to become an insurance agent. Anytime I say insurance agent, I also mean producer. A producer is an insurance agent. An insurance agent is an insurance producer. The actual name of your license is called a producer's license. What we do is we sell insurance and make proposals to customers. Most producers are 1099 contractors. We earn commission typically from the insurance companies. Most producers don't want to be salary. Commission will make you a lot more money than salary will. As an insurance agent, what we do is we find the customers, then we try to sell them insurance. If everything's cool, we then collect the information, write it on the application, then we quote them the price on the proposal. Then we send those proposals and applications up to the underwriter. As an agent, we don't work for the insurance company, but the underwriters typically do. The underwriter's job is to check over our application. The underwriter is the one that sets the price. We just quoted the price. The underwriter actually sets the price. The underwriter then decides whether to accept the policy, deny the policy, or issue it or decline it. Then the underwriter sends that information back to us, then we sell it to the customer. Underwriters can be kind of picky depending on the insurance company. For example, let's say you tried to sell a homeowner's policy to a customer. You take pictures of the house, and there's a tree branch over top of the roof. The underwriter might not approve that application until the customer cuts off that tree branch, because the underwriter's job is to help protect the insurer from having claims. So it's very beneficial to have good underwriting done up front. And then the word premium. Premium will be the monthly bill that the customer pays to the insurance company. You can pay your bill annually, quarterly, but typically most customers choose to pay on a monthly basis. Now let's get more into the definitions. Insurance is the transfer of risk. That is a test question. Your test will ask you which of the following best describes insurance, and insurance is the transfer of risk. Essentially, the customer will pay their small monthly bill to the insurance company. Then, when a large claim occurs, let's say $1 million, instead of the customer paying out of their pocket, the insurance company pays that claim. You've transferred the risk of you having a loss to the insurance company. You're still going to have risk, you're still going to have claims, but instead of you losing $1 million, the insurance company loses the $1 million. As an agent, we primarily transact business with the customers. The reason you're getting this license is so that you can sell insurance to these customers. You can also collect the premium for the insurance company. And then when that $1 million claim occurs, Then we try to handle the claim primarily just by taking the information and submitting it to the insurance company. Then they'll have a claims adjuster come out and actually adjust that claim and figure out the correct pricing and everything. The insurance companies utilize something called the law of large numbers. The law of large numbers states that similar people will have similar claims, and that if you project this across 1 million, 2 million, 10 million people, you can create a risk model to determine who's riskier and who's safer. So for example, who's a better driver, men or women? And statistically, women are better drivers than men. That's the reason why they receive lower insurance rates than a man. Don't get mad at me for that. That's because of somebody called an actuary. An actuary is a mathematician who works for the insurance company. They use the law of large numbers to predict losses. Actuaries are very, very, very important to the insurance company. They're the ones who decide whether or not insurance premiums go up, go down, stay the same, whether or not they should try something new or not. An actuary usually earns around $150,000 a year, but they can get up to, say, the $500,000 range if they're very good at their job, because the insurance companies rely on them to have a good risk model. That way they know how high or how low premiums should be. So the insurance companies take in your $100 a month. They take in $100 a month from many people. Then when you have a claim, the insurance company pays out for that claim. Then if you were like somebody else, next year your premiums would likely go up just like everybody else. You having a claim doesn't just affect you, it affects everybody else like you. So we have to try not to have claims and try to be a little bit safer in the future. Now this next definition is very important. This is the whole reason for your learning. You are learning to become a property and casualty insurance agent. Property insurance insures stuff. So like this marker is property. Your car is property. Your house is property. Property insurance insures items, things. Property insurance is known as a first-party claim because if your house burns down, it pays you directly. Liability is also known as casualty. Liability, also known as casualty insurance, pays claims to a third party. When you have a casualty claim, instead of you getting money, somebody else gets paid. So, for example, let's say you're driving your car and you rear end another car. Property insurance fixes your car. That's like collision insurance on an auto policy. But this other guy has medical bill damage. He has to be fixed. The casualty, also known as liability portion of your policy, will pay out claims to this guy and cover his medical bills. Casualty insurance, this is important for your test, is a contract between two parties and pays claims to a third party. Casualty insurance, also known as liability, is a contract between the insured and the insurer, and it pays out claims to a third party who was injured. You might not know this, but if you have people over at your house, and let's say your balcony falls, somebody's going to get hurt and they're going to sue you. Your homeowner's insurance has a liability portion to it that will cover that person's medical bills. Anytime you see the word casualty, also known as liability, think of it pays claims to a third party and it covers bodily injury and medical bills if somebody is injured. It's very, very, very important part on your test. I'll give you an example of two test questions. A contract that is between two parties and pays claims to a third is best described as what? Casualty, also known as liability. Then here's the next one. Which of the following best describes replacement cost on a casualty insurance policy? Is it a TV being replaced with the same make and model? Or is it medical bills? And since the question said replacement cost on a casualty insurance policy, the answer is going to be medical bills, because a TV being replaced for the same make and model is property insurance, not casualty. On your test, liability insurance is also known as Section 2. Section 2 of any insurance policy is known as liability. So if your test asks you, what is Section 2 of an employer's liability policy? You just pick liability. What is Section 2 of a workers' compensation policy? Liability. What is Section 2 of a homeowner's policy? Liability. Liability, also known as casualty, will always be Section 2 of any policy, and it pays claims to other people, not the insured. We're going to talk more about liability a little bit later on. Property insurance is what most people think of in an insurance policy, but liability does protect you from any lawsuits that could arise. There are 5 parts to an insurance policy: the declarations page, the insuring agreement, conditions, exclusions, and definitions. The declarations page, also known as the dec page, is the first page of an insurance policy. It's kind of like a summary of what you're covering and insuring. The insuring agreement describes what you're insured against, and if that occurs, the insurance company promises to pay claims. Conditions will be your duties after a loss. Exclusions are things that are not covered, and definitions will clarify the terminology used in a policy. The 5 parts to an insurance policy spell an acronym known as DICED. This is something that I would put down on my important notes section, because this will be on every test and it's not easy to memorize all 5 parts. The acronym DICED helps you with that. The first letter in each part spells D-I-C-E-D, DICED. Declarations page, insuring agreement, conditions, exclusions, and definitions. The way I like to teach is to help you pass the test. So we're going to be covering a lot of things on this slide here that is much further along in the program. But I like to try to get information in your head now. That way when you see it later on, it's a little bit easier. So the declarations page is the first page. Anytime you quote somebody insurance, you almost always ask them to send you their dec page. The state minimum auto insurance limits in Texas is 30, 60, 25. So let's say somebody walks into your office and says, hey, I'd like a quote for auto insurance. You say, great. You ask them first, well, what do you currently have? And customers never know what they have. So they'll probably say, oh, I have full coverage. And you'll say, well, in the insurance world, we don't say full coverage anymore because not everything's covered. So you'd say, well, what are your liability limits? They'd say, well, I don't know. I have good coverage, though. So you, as an agent, would likely quote them decent insurance limits, such as 100, 300, 100. And then you say, oh, well, you said you have full coverage. You likely have comprehensive and collision, so you add comprehensive and collision as well. So you run the quote and it comes back at $140 a month. Your customer would say, "You are crazy. $140 a month? That's nuts." You say, "Well, that's what the coverage is. How much are you paying now?" Customers say, "Oh, I'm paying $49.95 a month." They most likely do not have the good insurance that they think they have. They most likely have the state minimum limits. So then what you would do is you would tell the customer, "Well, let me see your declarations page. Let me see what you currently have." You would find out that they have state minimum limits. The deck page is the first page of a policy. As an insurance agent, you typically ask people to send this to you so you can compare apples to apples. The deck page will have the name of the customer. It'll have the name of the insurance company. It'll even have the name of the agent. It'll have the insurance customer's address, the insurance company's name, and the agent's name and address as well. It'll also have the policy period. Most policies are 1-year periods. I understand that auto insurance is sometimes written in 6 months, but every other type of insurance policy is in a 1-year period. It'll describe how much coverage the person has. So it'll say like they have state minimum limits and they do not have comprehensive and collision. It'll also have the VIN number of the vehicle. On homeowners insurance, it'll describe the house being insured. The deck page is like a summary of what is being insured. It tells you the coverages, how much they pay, everything that's on there. You will not be able to find very sensitive information here though. You will not find their social security number. You will not find things that aren't relevant to the policy. Like your auto insurance doesn't describe your house. Your house doesn't describe your auto. But the deck page is the first page of the policy. This is a summary of what is being insured and for how much you're insured against. The insuring agreement describes the perils that you're covered against. And if these perils happen, the insurance company promises to pay claims. So let's talk about homeowners insurance for a second. What do you think your homeowners insurance covers? You do not have to write these next things down. We'll cover them later on in different chapters. But I'm going to run through a lot of perils for your policy. So a peril is known as a cause of loss. And in insurance, we use 3 cause of loss forms. There's basic, broad, and special. The insuring agreement will tell you what perils your house is protected against and what the insurance company will pay when those perils occur. If you have a basic homeowner's policy, you are only covered against fire, lightning, and explosion. The basic perils are fire, lightning, explosion. They spell FLE, F-L-E. You can pay a little bit extra and get the basic extended perils, which is known as WARVs. Again, you do not have to write these down. You will learn these later on. I'm just trying to get them into your head right now. The basic extended perils, you pay a little bit extra for, let's say $50, and you're covered for wind, hail, aircraft, riot, vehicle, volcano, external explosion, and smoke. So the insuring agreement would say if fire burns down your house, the insurance company will pay your claim. If you have the basic extended perils, if a windstorm hits your house, the insurance company promises to pay claims. Perils are known as the cause of loss. The basic cause of loss form is FLE, fire, lightning, explosion. The basic extended perils are WARVs, wind, hail, aircraft, riot, vehicle, volcano, explosion, smoke. The broad cause of loss form covers everything basic does and big effect. The broad policy is a little bit better than basic. It'll cover flea, warves, and big effect. That's burglary, ice, glass. So like if somebody burglarizes your house, if ice damages your house, if glass breaks, accidental discharge, freezing of plumbing, falling objects, electrical collapse, and tearing asunder. The broad cause of loss form will cover flea, warves, and big effect. You pay a little bit extra for broad, so like basic insurance might be $100 a month, broad would be like $150 a month. The broad cause of loss form covers big effect, burglary, ice, glass, accidental discharge, that is not a gun, that is a water heater that burst or a pipe that burst. It's water damage that accidentally discharged in your house. So like if your toilet breaks and it starts spewing water everywhere, that's accidental discharge. Falling objects, that'll be if something falls outside your house in. Freezing of plumbing, electrical collapse, that's if your house collapses. Or tearing asunder, this has to do with air conditioning units. This is not on your test. But the insuring agreement would say, if you have a broad policy, if flea, warves, or big effect happens to your house, the insurance company will pay out your claims. And then special is the best insurance. Special insurance covers everything except what is excluded. Special will be known as open peril a little bit later on. So your insuring agreement would say if you have special insurance and a lawnmower flies through your windshield, not windshield, but your window, special covers that. Special insurance is the best insurance. It covers everything except what is excluded. So the insuring agreement would say, well, you have special insurance. So if this happens, the insurance company promises to pay claims. The declarations page describes what is being insured and for how much. The insuring agreement tells you what you're protected against. It'll describe the perils, either basic, broad, or special. And if these perils occur, the insurance company will pay out your claim. Conditions is a rather long part of the policy. It states your duties after a loss, meaning what you have to do and what the insurance company has to do when you have a claim. So for example, if somebody breaks into your house, you have to call the police if there's a theft. That's a condition. The insurance companies will not pay a claim unless you call the police in the event of theft. Let's say somebody hit and runs your car. You have to call the police. You also have to protect your property. So for example, if a tree falls into your house and makes a hole, you have to go and get a tarp and cover up the hole. That way more rain doesn't come into the house. If you don't know how to do it, you can call a contractor and they'll come put the tarp up. Your insurance policy will pay that. The conditions part of the policy states that you have 30 days to notify the insurance company when you have a claim. So you have to call up the insurance company, you have to cooperate with the insurance company. You must notify them when you have a claim. You also have 60 days to submit proof of loss. Proof of loss is a signed, sworn statement showing that you actually lost something. Typically, it is the claims adjuster who comes out and takes pictures of your property. Then you'll sign a loss statement saying you lost $10,000. Proof of loss, you have 60 days to prove that you actually had a claim. So conditions are your duties after a loss. It's what you have to do, what the insurance company has to do. So let's say your car's stolen. Yeah, you got to call the cops. But then another condition is that the police have 48 hours to find your car. meaning that you cannot get paid for a stolen vehicle during the first 48 hours. There's a lot of conditions on your test. We've only covered a few of them, but we'll cover the rest of them as we get along later into the chapters. Exclusions are items not covered under the policy. What do you think is not covered under homeowners insurance? So homeowners insurance does not like flood. Flood is excluded underneath homeowners insurance. Flood insurance is only insured through the federal government through the National Flood Insurance Program. So like you would have homeowners insurance and then a separate flood policy. Homeowners insurance excludes flood. Homeowners insurance also will not like earthquakes. Earthquakes are not covered under homeowners. In the insuring agreement, we learned that homeowners will cover volcanoes, but earthquakes are excluded. The main reason for that is we know where a volcano is. We can insure volcanic damage because there's not many of them. You know where they're at. If a volcano erupts, it's only going to affect that area, not so much your house in the middle of Kansas. Earthquake, however, we never know where they're going to hit, and it could collapse an entire city. It could be catastrophic. One earthquake is considered 3 days. One volcano is considered 7 days. So what that means is, if an earthquake hits your house today, then there's aftershocks tomorrow. That's still just one earthquake, and it's still excluded. Volcanoes, if a volcano erupts and it damages your house today, and then the lava hits your house 5 days from now, that's still one volcano. If you haven't got the gist yet that this is rather nuanced, it is. And this stuff will be on almost every test. We'll cover them in later chapters, but let's keep talking about exclusions. Insurance policies under homeowners also excludes underground pipes. Underground pipes, your test thinks are the city pipes, not your pipes. Homeowners insurance also excludes foundation damage. Homeowners insurance will also exclude war and inherent vice. Inherent vice is like leaving your door open and then going on vacation. It's where you create the conditions for something to occur. It's not quite intentional, but you kind of knew what was going to happen and somebody else did the damage. Homeowners insurance does not cover flood, earthquakes, underground pipes, foundation damage, war, inherent vice, or intentional loss. Exclusions are things not covered. Some policies also have limitations, saying that things are covered, but up to a certain extent. So for example, homeowners insurance will cover business personal property. Business personal property is like a work laptop that you took home with you. It's business, but it's property that you took home. So if your house burned down, it will cover business personal property, but up to a limit of $2,500. Homeowners insurance will also cover jewelry and furs, like a fur coat, up to $1,500 if they're stolen. If it burns down in a fire, you can get the full value. But if it's stolen, it has a limitation of up to $1,500. Exclusions are things not covered. Limitations are things that are covered, but up to a limit in the policy. So the declarations page, the first page, that's a summary of what insurance you have. Insuring agreement tells you what is covered and has the promise to pay claims. Conditions state your duties after a loss, like you have to call the cops and you have to give them 48 hours to find your car. Exclusions are things that are not covered. Limitations are things that are covered up to a limit. The definitions portion of your policy clarifies the terminology used. So like the whole volcano for every 7 days, that's a definition. Earthquakes 3 days, that's a definition. What do you think the difference is between a hostile fire and a friendly fire? A friendly fire is one that you set. That's like a candle, that's like a contained fireplace fire. A hostile fire is one that's angry. A hostile fire is one that gets away from you. So like you could have a fireplace and it's friendly, but then your drapes go into the fireplace and catch it on fire. Now it's a hostile fire. The definitions portion of your policy will define what the words mean. So I'm going to test your knowledge to see if you know what two of these words are. Most people have no idea what these two words are. We will learn them later on, but these are definitions in a policy. Do you know what the word subrogation means? If you don't know what it means, you could look it up in your insurance policy because it's defined near the end of the policy. Subrogation means the transfer of right of recovery. The way I remember this is subrogation means to sue. So for example, let's say we have an auto claim. This car hits this car. Then this car hits this car. Car number one is at fault. But he hit and ran. He's gone. He might have been drinking, something happened, I don't know, but that guy's gone. These two people will file underneath their insurance policies. They'll get paid from their insurance companies. Then their insurance company will subrogate against car one. They'll sue car one to get their money back. You transfer your rights to the insurance company to recover their money from the at-fault party. If you didn't know what that word meant, like I said, it's in the definitions portion of your policy. Here's another definition. Do you know what the word liberalization means? It's also in your policy. Liberalization is when the customer receives increased coverage, but their premiums stay the same. This is typically when a state law changes and the customer bought insurance, let's say yesterday, but the state law changed to where the insurance companies have to give higher coverage today. The insurance company has to increase your coverage, but they can't charge you any more because you didn't request that change. Liberalization is when you get increased coverage, but your premiums remain the same. That definition is also in your definitions portion of the policy. So to clarify the 5 parts, we have the declarations page that tells you the summary, that's what you're covered, how much you pay, everything that's included. The insuring agreement tells you what you're covered against. So like, does homeowners insurance cover flood? No. But auto insurance will cover flood. You do not have to go through the government to get auto insurance to cover your flood. Car insurance covers flood because you can move the car, whereas homeowners insurance, you can't move your house if there's a flood coming. So like the insuring agreement tells you what's covered, and then if this happens, the insurance company promises to pay claims. Conditions state your duties after a loss. You have 30 days to notify the insurance company. Then you have to submit proof of loss within 90 days. Exclusions are things not covered, like earthquakes, underground pipes, intentional loss, inherent vice. Limitations are things that are covered, but up to a limit. So like business personal property was $2,500. Jewelry was up to $1,500. And then the definitions clarify the terminology used in a policy. It's where it defines what these words mean. So let's ask you some test questions. We'll start off easy, then we'll get difficult. Which of the following is not found on the declarations page of a policy? Insured's name, agent's name, insured's address, insured's social security number. You will not find their social security number on the deck page. Which portion of the policy describes the property being insured? And that is the declarations page. It describes what is being insured. On your test, which portion of the policy describes the perils insured against? That's the insuring agreement. The insuring agreement tells you what your property is covered against. Where can you find the promise to pay in an insurance policy? That is the insuring agreement. On your test, where can you find the notice of claim provision? That's in the conditions. On your test, where can you find items that are not covered under a policy? Exclusions. Then here's a very difficult one. Declarations page is not an option. Do not pick that. That's not an option. Your 4 answers are insuring agreement, conditions, exclusions, definitions. These are your 4 options. Where can you find a description of an insured in the policy? And the answer is in the definitions portion. Different policies consider the insured different depending on which type of insurance. So for example, in property insurance, if your house burns down, it pays you. But if somebody gets injured on your property, the liability portion pays out to that person. The definitions portion will describe who is an insured under the policy and what the definition of an insured is. It'll clarify exactly who is covered depending on the situation. Then your test likes to ask you, all of the following are parts of a policy except declarations page, insuring agreement, conditions, exclusions, definitions, and arbitration. There is no A in diced. Your test will say which of the following is not covered under the policy? Declarations, insuring agreement, conditions, and negotiation. There is no N in diced. So arbitration and negotiation are not parts of an insurance policy. The 5 parts spell the acronym diced. So if you ever have all of the following are covered under the policy or all of the following are included in the policy except, memorize diced, declarations, insuring agreement, conditions, exclusions, definitions. There's no A or N in diced. This is a very important part on your test. Now these next definitions are relatively quick. They're not very difficult to memorize. A hazard is something that increases your chance of loss. A peril is the cause of loss. So like a hazard would be a tree branch over top of your house. It hasn't caused any damage yet, but when it falls, it could cause damage. The tree branch increases the chance of having a claim. If you drive too fast, that is a hazard. If there's a pothole in the road, that is a hazard. Hazards increase your chance of loss. Perils are the cause of loss. Let's first finish up hazards before we talk about the perils again. A physical hazard is something that you can physically touch, pick up, move, change, feel. A physical hazard would be like a broken railing, a broken step. A physical hazard could be like trash debris on your floor. Physical hazards are things that increase your chance of loss that you can physically touch. A moral hazard is when you're dishonest or you do something you know you shouldn't be doing, but you do it anyway. You are in control of your actions and you decide to perform those actions for whatever reason. So like speeding is a moral hazard. You know you shouldn't be speeding, but you do it anyway. Moral hazards also are when people lie on their application. There's going to be many times when a customer says, "Oh, I've never had a speeding ticket," but then you pull their driving record and they've had like 5. Moral hazards increase the chance of loss to the insurance company, typically through the actions that the customer chooses to do. A morale hazard is a person who is careless, indifferent, or imprudent to loss. A morale hazard typically is not intentional. It's just either a thoughtless action or when you can't control yourself. So if you've ever had road rage before and you start driving real fast because somebody cut you off, you're not intentionally doing that. You're just so angry and so caught up in the moment that you are careless. That is a morale hazard. A morale hazard ends in an E. Carelessness, indifference, and imprudence all have a bunch of E's in them. So if your test ever asks you, which of the following best describes an indifference to loss, that is a morale hazard. An imprudence to loss ends in an E, morale hazard. Morale hazards are thoughtless actions where you can't really control it at the time. Now let's go back to peril. So peril is the cause of loss. If you remember from the previous slide, the 3 cause of loss forms were basic, broad, and special. The basic perils were fire, lightning, and explosion, flee. The basic extended perils were wharves. Again, you don't have to write this down here. I'm just trying to get them in your head. You're going to have to memorize this, and repetition is the best. The basic perils were flee. The basic extended perils were wharves. Wind, hail, aircraft, riot, vehicle, volcano, explosion, smoke. The worst insurance covers flee. Then you can pay a little bit extra to get wharves. The next best one is broad, which covers big effect. Burglary, ice, glass, accidental discharge, falling objects, freezing of plumbing, electrical collapse, and tearing asunder. Big effect covered everything basic did and all of these extra perils. And then the special perils were open peril. It protected your house against everything. Peril is defined as the cause of loss. Hazards increase your chance of loss. You're going to have to memorize the basic, broad, and special perils a little bit later on. These next definitions are also relatively easy to memorize. The 2 more important ones are up here. The next 2 are not that important. A direct loss on your test is a consequential loss. A direct loss on your test is like a house that burns down by a fire. The fire directly caused the damage to the house. Direct losses are things that occur today and you get paid for relatively quickly. An indirect loss is known as an inconsequential loss. And on your test, an indirect loss is a loss of income, something that occurs over time, also known as time element. If your house burns down, where are you going to live? Let's say the house burned down and you had somebody renting a room. Are they still going to pay you for that? Indirect losses are like having to be put up in the hotel. This is a hotel. After your house burns down. Indirect loss is rental income. Indirect losses occur after the fact, and you receive this payment over time. That's why it's known as time element. Later on, you're going to learn in homeowners that coverage D is an indirect loss. Coverage D will cover your loss of income and put you up in a hotel should your house burn down. Direct losses occur today. The fire directly damaged your house. Indirect losses occur over time. That's a loss of income. Indirect losses are inconsequential losses. We'll talk more about these later on. The next definition is salvage. If your house burned down, you might not have lost all your stuff. Your 65-inch TV might have survived. Your insurance company now owns all the stuff that they paid you for. They're then going to sell that stuff to try and recoup their losses. Salvage is when the insurance company pays out a claim, then owns the property, then sells it to recoup their losses. Like if you total a car, somebody's going to buy it and put it up at auction after they fix it up. Salvage is where the insurance company tries to get back some of their money. Abandonment is not important on this test, but the insurance company will not cover something you've abandoned. So like if you just leave your house, you're not going to get any money. The house has to burn down. We'll talk about the pair-set clause in a minute. Let's kind of cover these first, then we'll get to this one up here. It's a little bit in depth. A deductible on your test is also known as a retention limit. Retention limit is the amount of money you have to retain in the event of a claim. So let's say you have a $250 deductible and you have a claim of $10,000. You have to satisfy your deductible first before you get any money. Deductibles are paid out before the claim, and deductibles help offset your premiums. If you have a higher deductible, your insurance premiums go down. If you have a lower deductible, your insurance premiums go up. A lot of people for auto insurance choose a $500 deductible because it's relatively safe. You get in a car accident, $500, they'll fix your car. But if you went down to $250, your premiums would go up. If you went up to $1,000, your premiums would go down. Deductibles help keep the customer thinking. If you have to pay $1,000 out if you get in an accident, you're probably going to drive a little bit safer than if you only had to pay out $50. So deductibles are amounts that the customer retains. Deductibles are deducted from a loss, meaning that you never get paid for your deductible. Deductibles affect your premiums, and deductibles are also met per occurrence. An occurrence a little bit later on will be something that is paid out over time or something that occurs over time. So like, for example, if I hit a car, then I spin down and hit a wall, and then I flip over the wall and land on another car. That's all just one occurrence. I hit multiple things, but it was one total reaction. I'd only have to meet one deductible, not $250 each time I hit something else. As long as it occurs at the same time, that's going to be an occurrence, and deductibles are met per occurrence. The next definition is vacancy. Vacancy is when a building is completely empty. There's nobody in the building. There's no stuff in the building. It's just an empty building. We don't like vacant buildings. Unoccupied is when there's nobody in the building, but there's still stuff in the building. So an unoccupied house could be like a vacation home. It's a secondary house, but you have your stuff in there. An unoccupied property is like a business that closes at night. So from, say, 5 p.m. to 8 a.m., the building is unoccupied. There's nobody there, but there is stuff there. Vacant buildings are completely empty. If a building is vacant for longer than 60 days, there is no coverage for glass, theft, or vandalism. Typically, if a property is vacant for 60 days, the insurance companies start diminishing coverage because the person doesn't care about the building. So we don't really like vacant buildings. There's nobody there. There's no stuff there. There's no reason to go if it's just completely empty. We will cover unoccupied buildings, though, because when you have stuff there, you're likely going to check in on it and make sure it's all up and well. Now let's talk about the pair or set clause. This one is a little different. So let's say you have two shoes, and your shoes together are worth $100. But one of the shoes burns up in a fire. So you have one shoe left. The insurance company doesn't just divide it in half. They pay you the proportional amount. So one shoe by itself is probably only worth $5. So your insurance company will pay you $95 for the damaged shoe. Because nobody wants to buy just one shoe. You need two. Unless somebody else also burned up in a fire, that's why they gave you $5. The pair or set clause states that the insurance companies will pay the proportional amount of the loss, which does not always mean you divide it equally. I'll give you another example. On your test, let's say that you have 5 plates, part of a set, and each plate is worth $6,000. So total, they're worth $30. One of the plates breaks. So you now have 4 remaining plates valued at $20,000 total. Since the plates are part of a set, they all go together, the insurance company is going to pay you $10,000 for the one plate. Because when they were together, they were worth 30, but without one, they're only worth 20. The amount you lost was 10. The pair or set clause states that they'll pay the proportional amount if you have a pair or set that goes together, like 2 earrings. The reason why they pay that difference is because of a word we're going to learn later on known as indemnity. Indemnity is to make somebody financially whole. Let's keep going along with the definitions, though. If you have multiple insurance policies, that's covered under something called the other insurance clause. So, for example, if you have 2 auto insurance policies, I don't know why, but let's say you do. One policy will pay primary, the other one will pay excess. I'll give you a real-world example. When you have auto insurance, the vehicle is insured, not the person. So like, let's say I have insurance on my truck, and I allow you to drive my truck. If you get in a car accident, my insurance is primary. Then if you also have insurance, your insurance is secondary. We insure the primary thing first, then the driver comes in secondary over top of that. So you might actually have 2 insurance policies if you borrowed my truck or drove my truck. That's covered under the other insurance clause. The other insurance clause will determine which plan is primary, which plan is excess when you have multiple insurance policies. This also works in property, but property insurance doesn't use primary and excess. So let's say I have homeowners insurance through 2 insurance companies. So let's say that the house is worth $100 total, and Company A insures it for $60,000. Company B insures it for $40,000. The other insurance clause doesn't do primary and excess. They share, known as pro rata. If I have a claim of $10,000, Company A will pay 60% of that claim, which ends up being $6,000. Company B will pay $4,000. Under the other insurance clause, in property insurance, they share. Liability typically does primary and excess, whereas property insurance shares. Now let's throw in another company there. Let's say Company A insures it for $60,000, Company B insures it for $25,000, and Company C insures it for $15,000. If I have a claim of $40,000, Company A pays 60% of that claim, so that ends up being $24,000. That's Company A. Company B will pay 25% of that claim, so that ends up being $10,000. And then Company C will pay 15% of that claim, and that ends up being $6,000. They're going to share. In the real world, this typically only happens if a person has changed insurance but forgot to cancel their policy. Or if they had homeowners insurance and then the mortgage added extra insurance on top of that. Or if you have a high value house, $2 million, $5 million, $10 million or above, then typically you'll insure it through multiple insurance companies. But this is rare in the real world. But this is how it works if you have multiple insurance policies on property. So under the other insurance clause, if you have multiple insurance through multiple insurance companies, liability policies typically pay primary and excess, whereas property insurance typically pays pro rata. They'll share. This provision protects the insurance company because instead of them all paying out and people profiting off insurance, they have to work together so that everybody pays proportional amounts. This is a definition, the other insurance clause, you'll likely forget. If I was to put something on my important notes, I would put the other insurance provision there, also known as pro rata. An occurrence, which we talked about previously, is something that occurs over time. It's an ongoing event or a repeated event. So like one volcanic eruption is 7 days. That's one occurrence. One earthquake is 3 days. The way I remember the two is that lava moves slow, so it's going to take 7 days to take out your house. Whereas earthquakes occur rather suddenly, so they only get 3 days. That's still one occurrence. Again, deductibles are paid out per occurrence. Now we have more definitions. Assignment on your test means transfer of ownership. Assignment is when you make somebody else the policy owner of the insurance policy. So for example, let's say you have a car and you then give the car to your 18-year-old son. It's now his vehicle. He might not want to buy a new policy because he likes his insurance policy, so you would assign the policy to them. You transfer the ownership of the insurance policy from yourself to your son. However, insurance companies don't like 18-year-old boys. So the insurance company must approve all assignments in writing. So you'd have to go to the insurance company and say, hey, look, I'm going to give my son this car, and I also want to make him the policy owner on the policy. Insurance company would say, cool, but we have to approve it. And they have to write a letter, very simple letter, it's standard, saying now the new owner is the 18-year-old son. All assignments must be done in writing and approved by the insurance company. So assignment means transfer of ownership. All assignments must be approved by the insurance company in writing. If you die, your insurance policy automatically transfers to your legal representative. That's like your lawyer or your wife or your husband. Whoever is in charge of your stuff automatically owns the policy. Your test has a tricky question. They'll say, which of the following best describes assignment during death? Automatically transfers to legal representative. Automatically transfers to legal representative after court appointment. And it doesn't have to be until court appointment. It automatically transfers to your legal representative. So whoever automatically takes over your stuff is the person who will own your insurance policy. So all assignments automatically transfer to your legal representative in the event of death. Subrogation is the transfer of rights of recovery. Assignment is the transfer of ownership. Subrogation we talked about earlier, and subrogation means to sue. So again, if you had that car accident where this guy hit this car, then that car hit this car, then this guy ran. These guys' insurance policies would pay them, then they would subrogate against the first party. Subrogation is the transfer of rights of recovery, and it allows the insurance company to sue on your behalf. That way they can get their money back. So subrogation is the transfer of rights of recovery. It means to sue. Assignment is the transfer of ownership. And then if you remember, the definition of insurance is the transfer of risk. So these will be on your test. Many people get the transfers mixed up. Assignment is the transfer of ownership. Subrogation is the transfer of rights of recovery. And insurance is the transfer of risk. We already talked about an occurrence. We already talked about primary and excess. Let's go back to liberalization because we've covered that one before. Liberalization is when the customer gets increased coverage, but their premiums stay the same. Typically, when a new state law takes into effect, the insurance companies have to up your coverage, but they can't charge you anymore. Most policies have a 45-day liberalization clause, which means that if the state law changes, the insurance companies will have 45 days to enact this provision. Or if you buy a new policy and they come out with better insurance in the next 45 days, they have to enact this provision. Liberalization is increased coverage, but the premiums stay the same. The next definition we have is a binder. I'm going to cover the test questions first, but then I'll talk a little bit more about it. On your test, binders are good for 60 days. And on your test, binders are temporary coverage, either oral or written. Now let's kind of talk about what it is. You're an insurance agent and you're eating dinner with your family. A customer calls you up on your cell phone. Says, hey, I'm at the dealership, I'm buying a new car. I need coverage on this car. You try to log on to the insurance company's website, but it's down for maintenance. So what you can do is you can write up your own auto insurance card and send it to the customer. They are now bound with coverage. It's temporary insurance, and it gives you, the agent, time to submit it to the insurance company. Typically, if we have to wait for underwriting every time, things go very, very, very slowly. So you're able to do certain things in your office, like insure things, without having it go through underwriting today. You'll submit it a little bit later on. If somebody buys a new house, the insurance company might not have pictures. So they'll issue a binder in the beginning, then they'll go out and take pictures, then they'll get the real policy number. Binders are temporary coverage, either oral or written. You can tell people, hey, you're covered, and they're covered, but they're only good for 60 days. At the end of the 60 days, you have to write another binder. This helps get things done a little bit quicker. Instead of having to wait on the underwriter every time to issue a policy, we usually give out binders. Construction contractors get these a lot. They just started up business yesterday. You know how much it's going to cost, say $600 a year. You'll give them a binder. Then they can share that to their customers that they have insurance today. Then their real policy number will come in the future. These next two are also on most tests. Appraisal is when you have to figure out the value of something. You might have an engagement ring of a customer, and they say it's worth, it's a ring, they say it's worth $20,000. But you know it's not worth $20,000. So what you have to do is get an appraisal. And the appraisal comes back and says it's only worth $15,000. You insure it for the appraised amount. Appraisals are to determine the value of how much something is. Arbitration is whether or not you actually have coverage. So let's say, for example, a hurricane's coming. So you pack up your things and you leave. Then you come back and your house is gone. The insurance company is going to say that a flood took out your house because they want to push that off on the flood insurance program through the government. But you would rather the private insurance company pay out. So you'd rather say that the wind took out your house. Now you don't know whether or not you're covered under the government or covered under the private insurance company. Then you go into arbitration. Arbitration is whether or not there's actually coverage to be had because you might have the wrong insurance, a different insurance, or which company should pay it out. If you have to go into an appraisal or arbitration scenario, either party can invoke it. So if the insurance company denies your claim, you can say, I want arbitration. Or if they say it's worth this amount, you can say, I want a new appraisal. You have to choose and pay for your own appraisal. They choose and pay for their own appraisal. If you still can't decide whether or not you're covered or for how much, then you can go and get an umpire. An umpire makes the final decision, how much it's covered for or whether or not there's coverage. You share the costs of an umpire because that's the one mediating, determining the difference. Appraisal and arbitration help keep things out of the court system. That way you can get it kind of streamlined instead of having to go through a lengthy court battle. The next definition we have is a certificate of insurance. In the real world, we call these COIs. But a certificate of insurance is evidence of coverage. This is what the customer gives to other people to prove they have insurance. This is your auto insurance card. So like if the cops pull you over, you give them your certificate of insurance, which is your auto ID card. It'll have your name. It'll have the insurance agent's name. It'll have the insurance company's address. It'll have your coverages. And it'll also have your policy period. So from like May 1st to May 1st next year. The certificate of insurance is just to show you have this amount of insurance, who you're covered through, and how long you're covered through. This is what you give to other people. You will not find your premiums on your COI. You don't have to show everybody how much you're paying. That's found on your deck page. The next word we have is a very important word in the insurance industry. It's called indemnity. On your test, indemnity is the founding principle of insurance. Indemnity is to make somebody financially whole up to the limits of the policy if they have a claim. So for example, if you have a car and I go and kick a dent in your car, the insurance company's not going to buy you a new car. They'll just fix the dent. That's indemnity. You have been made financially whole for the damage up to the limits in your policy. Let's say you had that ring, and the ring you said was worth 20, but the insurance company only insured it for 15. If the ring is lost, let's say fire, the insurance company only pays you up to the limits. Indemnity is to be made financially whole. It is the founding principle of insurance. We'll learn more about this on the next slide. The next definition we have is proximate cause. Proximate cause is the first thing in the event of an occurrence. So for example, let's say wind blows open a door to a house. The door breaks, knocks into a lamp that's on a table. The lamp falls down and breaks and cuts a child's leg. The wind is the proximate cause. Proximate cause is the first thing in a chain reaction that caused everything. Remember when we were in a car accident? I'm the bad driver. I hit you. You hit the next guy. I am the proximate cause. Proximate cause is kind of cool. Because if you remember, insurance companies don't like to cover flood. But let's say, this is not on your test, it's just for teaching. Let's say you'd put sandbags all around your house, and the hurricane's coming. The water comes up, but the sandbags divert it. Everything's working out perfectly. But then a wind comes and knocks down some of your sandbags. Now the water rushed in. The proximate cause was the wind, so then this would be covered under homeowners because it's not technically flood, it's wind damage. Proximate cause is the first thing, and whatever caused the damage first is the actual peril. Let's say that your house is on fire, and the firefighter uses water to put out the fire. Damages all your stuff for water. We typically don't like water damage. This is covered because the fire was the proximate cause. Let's say that another firefighter takes your TV, places it on the side of the road, and the TV mysteriously disappears. So the firefighter was trying to protect the TV, they set it on the side of the road, then it's gone. We don't cover mysterious disappearance, but the TV would have never been out there had there not been a fire. So since the fire was the proximate cause, the TV's mysterious disappearance is covered. Proximate cause is the first thing in a chain reaction, and that is the initial peril. The subsequent damage after that falls in line. Now the next definition we have is proof of loss. Proof of loss, as we covered earlier, is a signed sworn statement. Typically it's pictures of your property. We have 60 days to submit proof of loss to the insurance company. So you have to say, hey, this is what happened. Here's the proof that I had this loss. You have to sign this statement saying that you had this claim. And the insurance companies will then use this to pay out their claims. Proof of loss is a signed sworn statement that we have to submit within 60 days. So I want to run through some of the numbers real quick. Notice of claim was 30 days. Proof of loss is 60 days. And a binder, which was temporary coverage, was also 60 days. Property and casualty relies heavily on numbers and days in order to pass. There's a lot of memorization on this test. The next definition we have is ambiguous. Ambiguous means vague, unclear, or contradictory. An ambiguous statement would be such as, we might cover this, but only if this happens, but if that doesn't happen, then we might cover it as well. Insurance policies have to be very clear and concise. They have to define everything perfectly. If the insurance company does not define it perfectly, and there is some question as to whether or not it's covered or not covered, the insured will win any lawsuits. So I'll give you an example. A lot of insurance companies tried to deny claims due to an act of God. But you cannot define an act of God. There's no clear definition. So a guy in Virginia had lightning strike his air conditioning unit. He filed a claim, said lightning struck my air conditioning unit, lightning's a covered peril, I'd like to be paid. His insurance company said, no, that's an act of God. And the guy said, no, that's lightning. Since there is an ambiguous statement, you can't define that. They went to court and the insured won. If a policy has an ambiguous statement, the insured will win that lawsuit, not the insurance company. Insurance companies have different ways of valuing losses. The two most common are replacement cost and actual cash value. Replacement cost would give you the exact amount to replace whatever you lost at the exact same value today. So like if you had lost a television in a fire, replacement cost gives you a brand new TV. Actual cash value factors in depreciation. Actual cash value is replacement cost minus depreciation. So let's say you had one of those big projection screen TVs from like 10 years ago. The things were huge. If that burned down today, the TV back then cost you $4,000, but it's depreciated so much because of new technology that if you had the TV on actual cash value, you would only get like $50 for that big TV. Whereas replacement cost would give you the exact amount to buy a new TV of like kind. Replacement cost is better than actual cash value. Auto insurance uses actual cash value to fix cars because the mileage on the vehicle is the depreciation. So like if you had a 2002 Ford F-150 with 100,000 miles, you're probably only going to get like $4,000 or $5,000 for the car. Whereas replacement cost would give you the $30,000, $40,000, $50,000 to buy a brand new truck. Replacement cost is better. Actual cash value factors in depreciation. Auto insurance uses actual cash value. Homeowners, typically the structure is replacement cost. And then the stuff inside is actual cash value. You can endorse a homeowner's policy up to replacement cost for the contents, but it costs more money over time. So replacement cost to buy something new, actual cash value factors in depreciation. On your test, actual cash value goes hand in hand with indemnity, because indemnity is to be made financially whole. If you have 100,000 miles on the truck, financially whole is going to get you $5,000, not $30,000. You would be making a lot more money with replacement cost. So actual cash value and indemnity go hand in hand. We obviously would rather have replacement cost for most of our stuff. Market value is for rare, historic, or unique items. Market value is when the cost to repair it is much more than the replacement cost. So, for example, an old house built in 1850. You have to somehow get wood from 1850 to replace that to the exact same standard. You can't just go to Home Depot and get that old wood. Market value would give you the amount to purchase for that old historic house. On your test, the only time we use market value is with an HO8 policy. That'll be a homeowner's Form 8, and that'll be a market value policy. Agreed value is typically when you had an appraisal and the insurance company agrees that's how much it's worth. Agreed value will be used on something called personal articles insurance. Personal articles insurance is where you insure high-end stuff that typically has to have a appraisal. The cool thing is if you insure something on agreed value, you don't have to meet a deductible and you don't have a co-insurance requirement, which we'll learn what co-insurance is a little bit later. But agreed value, you pay extra for this insurance. That way you get exactly how much you say it is and they agree, typically because you had that appraisal. Since you're paying extra for this insurance, you don't have to meet a deductible, you don't have to meet co-insurance requirements. Agreed value is not used very often. Stated amount is similar to agreed value, but this is where you tell them how much it's worth, and they never agree that's how much it's worth. They just say, okay. Stated amount is almost never used. You might use it on a unique car. So like a 1969 Ford Mustang that's been completely rebuilt. An appraisal is not going to do it any justice. So you just have to tell them exactly how much to insure it for. They don't agree that's how much it is, but that's how much it's covered for. Stated amount is just, this is how much it is. Very rarely used. Replacement cost is typical. That's on the structures of property. Actual cash value is auto insurance, and that's going to be the contents inside the house. Market value is for historic homes, and that'll be at HO8. Agreed value has the appraisal, and you paid extra, so you don't have to meet a deductible or co-insurance for this. And stated amount is very rarely used, not very important on the test, that one. Now, the next definitions that we have are very simple, but they're on the test. An insured is any person covered underneath the policy. So like if you have auto insurance and you let a friend borrow your car, they're an insured. They're not listed on the policy, they're just covered. Anybody covered under the policy is an insured. In business insurance, that'll include the employees, the stockholders, the lawyers. Anybody that runs the business is also considered an insured. The first named insured is the person whose name comes first. The first named insured is the policy owner, and that's the one who has to pay the bill. That's the one who can cancel it. In personal insurance, like home and auto, first named insured doesn't really matter. But in business insurance, you can have multiple subsidiaries. So whichever company comes first on the policy, that's the actual owner of the policy. The first named insured is the only person who can make changes to a policy. An additional insured is a mortgage company or a lien holder. So if you have your house and it's worth $100,000, but you have an $80,000 mortgage, the mortgage company is an additional insured. So if your house burns down, the mortgage company gets their 80, you get the remaining 20 of the coverage. Additional insureds have an insurable interest in the property because they own the property, like the house or the car. So they're added onto the policy. If you ever don't pay your insurance, the additional insured, the mortgagees and lien holders get notified as well. So it's very important to make sure that if a vehicle is ever financed, you add them as an additional insured. Or if a house ever has a mortgage, you add them as an additional insured. That way they know you have insurance and they don't ask you to get them or buy their insurance. A named insured is anybody named in the policy. So an insured is anybody covered. First named insured is the person who can make changes. An additional insured is like a mortgage company and lien holder. And a named insured is anybody named in the policy. Next thing we're going to talk about is co-insurance. Co-insurance encourages property insurance to value. You have to insure property, houses, businesses, structures. You have to insure property to at least 80% of what it's worth. So if a house is worth $100,000, you have to insure it for at least $80,000. Most insurance companies require you to insure property to at least 80%. If you insure it for under the 80%, your claims get reduced by a percentage. So for example, if the house was worth 100, but you had 80% coinsurance, and you only insured it for 60, remember, you're not supposed to be able to, but let's say you did. You only insured it for 60, and you have a claim of $40,000. You're only going to get $30,000 of that claim paid, even though you insured it for 60, because you use an equation. The amount of insurance you have, that's 60, over the minimum required, that's 80. 60 into 80 is 3/4, that's 75%. So any claim under 60,000 is going to be reduced to 75% payout. Coinsurance is a penalty for underinsuring. You have to insure things for at least 80% or else you don't get your full amount of claims. Unless it was a total loss. So like if the house burned down completely, you would get your 60. But if you have any claim under the total loss, it gets a percentage paid out. So let's run through a couple scenarios. Let's say a house is worth $100,000 today, and it appreciates $2,000 a year for 10 years. The house is now worth $120,000. The minimum you can insure the house for today is going to be $96,000. You have to insure property to at least 80% of its value today. If the house had depreciated $2,000 a year for 10 years, so the house was only worth $80,000 today, then you'd have to insure it for $64,000. You have to insure things for at least 80% or else you get penalized on any of your claims. There's more to this, but it's not super important for your test. This will be on your test, but a lot of people get confused by the math. So if you see these questions, don't worry too much. Try and get the rest of the stuff on the test answered correctly instead of focusing on how to do math and percentages. You could waste hours teaching yourself math for one question. It's not that important to know this. You're trying to pass the test, not become an actuary for an insurance company. Next thing we have are third-party provisions. These are not super important, but they could be on your test. They're very simple. If you have a mortgage company, the mortgage company is an additional insured. They get paid first if your house burns down. The next word we have is a bailee. A bailee is somebody who has care, custody, and control of your stuff. Bailees are dry cleaners, jewelry repair shops, and TV repair shops. Bailees are typically places where you drop stuff off, they fix it, then they give it back to you. So let's say you have a dry cleaner and you drop off a dress. That's a dress. I don't know how to draw a dress. So you drop off a dress at the dry cleaner. The dry cleaner burns down. The bailee does not get any money. The bailee has a no benefit to bailee provision, which states that bailees cannot get any money for the stuff they have. The insurance company would have to pay you directly for your stuff, not the dry cleaner. Bailee insurance also has a damage to property of others exclusion, which means that they don't get paid if they damage your stuff. Bailees are in care, custody, and control of your property. They can't get paid for your stuff. No benefits are paid to the bailee. Now let's just kind of look at this mortgage scenario down here real quick. Jay has a $100,000 home, $80,000 mortgage. You insure your house to $100,000 replacement cost. When your house burns down, how is it paid out? 80 to the mortgage, 20 to you. Mortgage companies get paid first. And I want to make one more distinguish about a bailee. Later on, we're going to learn something called a garage keeper. A garage keeper is an auto repair shop. Auto repair shops, we don't call them bailees, we call them garage keepers. So like Jiffy Lube, auto dealerships, valet, anything that works with cars is not going to be a bailee. They're going to be a garage keeper instead. They work the same way, but dry cleaners, jewelry repair, TV repair shops are specifically bailees. That's what we call them. And again, they do not get paid if your stuff is damaged by them. You directly would get paid. Negligence is very important on your test. Negligence is the failure to act as a reasonable, prudent person would be. Every day you're negligent. If you speed, you're negligent. If you get real excited, you go running down a hallway, you're negligent. A reasonable, prudent person would not speed. Negligence is careless acts. There are 4 parts to negligence: legal duty, breach of legal duty, proximate cause, and damages. I do not have a good way to memorize this. No acronyms, nothing fancy. You will have to memorize this for your test. It loves to ask you which of the following is not needed for negligence: legal duty, negotiation, proximate cause, and damages. And negotiation was not one of them. These are the 4 parts: legal duty, breach of legal duty, proximate cause, and damages. I will explain this. The first question is, did you have a legal duty to act? So let's say you were speeding and you hit a car. Legal duty, you were not supposed to be speeding. You were not supposed to hit that car. So you did have a legal duty to act properly while driving. Breach of legal duty. Did you breach that legal duty? Yes, because you were doing 75 and a 55. Proximate cause. Are you the reason for the car accident? Yes, I wasn't driving well and I hit a car. Damages. Were there damages? Yes. Now that you have the 4 parts, you've met the negligence, so you are now liable for any acts of that happened during that accident. So legal duty is, were you supposed to act? Breach of legal duty, did you fail to act? Proximate cause, are you the initial reason? Yes. Damages, yes. Now the customer or the person injured can sue you. Negligence would also be like a roofer selling superior shingles, but then installing inferior shingles. So like they upsold on really good shingles, but then they installed really bad shingles. Legal duty, yes, you were supposed to install the correct shingles. Breach of legal duty, you installed the wrong shingles. Proximate cause, yes, it was your fault. Damages, yes, the roof is not as good anymore. So negligence can sometimes be not intentional, but it's usually when you forget to do something. It's a thoughtful act. Thoughtless act. Punitive damages are a punishment. Punitive damages, when awarded in lawsuits, are punishments to discourage unsafe business practices. So like most people like to talk about the McDonald's coffee cup case. Some woman bought coffee. She was driving and she spilled coffee in her lap. She sued McDonald's and initially the jury awarded her $2 million. It's a lot of money for spilling hot coffee on yourself. But let's kind of delve into the case very quickly. The woman who got burned was burned very, very, very badly. She was a white woman and a portion of her body was burned black. That's how hot this coffee was. It wasn't just regular hot, it was scalding hot. She initially went up to McDonald's and said, look, your coffee burned me. I need $10,000 to cover my medical bills. McDonald's said no. Then she got a lawyer. Lawyer said, look, $50,000 will cover medical bills, cover my fee. McDonald's said no. So then she sued. And they go to court and they find out that McDonald's had increased the temperature of coffee to almost boiling, which is 205 degrees, because more people would buy the coffee because it lasted longer and the aroma, the smell, also went further out into the store, enticing people to buy coffee. The jury felt that McDonald's put profits above safety, so they decided to punish McDonald's by giving her 1 day's worth of coffee cup profits. That's a punitive damage, a punishment. Insurance policies do not cover punitive damages. They'll cover damage to the person, but not any penalties awarded by a jury. Now, if you ever get accused of negligence in a liability claim, you can try and use these defenses to protect yourself. I'm going to start from the bottom and work my way up. The statute of limitations is usually the first one you try. Did the person wait too long to sue? Typically, they're going to have 2 to 3 years to sue after a claim. So if you're past the 2 to 3 years, not covered, not going to win. Intervening cause is another defense you can try to use if somebody accuses you of being negligent. Let's say that you have a house and it starts snowing. You're supposed to clean off your walkway to your house. So you wake up at 5 a.m. and you shovel your sidewalk. Then you go to work. At 9 o'clock, it continues to snow and it makes your sidewalk snowy again and slippery. Somebody walks along, falls on your sidewalk. They'll sue you and say, hey, you should have shoveled your sidewalk. You would say, no, I tried to act reasonable. I shoveled my walkway at 5 a.m., but the snow intervened. And the snow kept snowing even after I shoveled my walkway, so that is an intervening cause. It's not my fault that you slipped and fell. Intervening cause is where you try to say, hey, I tried to help out, but it didn't quite work out. Assumption of risk is a really good defense against negligence. This is kind of like blaming the victim. You say, dude, you knew what was going on. It's not my fault that you decided to do this. So for example, let's say you and your friends are out drinking and you don't want to drive. So you give the keys to your other friend who's also drunk. Then you both get in the car and get in a car accident. If you tried to sue your best friend, they would say, no, you assumed the risk when you got in the car with a drunk driver, so it's not your friend's fault that you got in an accident. This also works at sporting events. That's when you're like watching baseball, then the baseball hits the person in the head. They assume the risk, so therefore it's not the baseball player's fault. You know what's going to happen at a sporting event. Contributory and comparative are the two confusing ones. Contributory negligence almost no states use anymore. Contributory negligence is also blaming the victim. This is where if the victim was even 1% responsible, they don't get any money. Contributory negligence, you would say, hey, I might have been doing 110, but he was doing 75, and the speed limit's 55. So he is 1% responsible for this. Since he contributed to the accident as well, no coverage. Almost no states use contributory negligence. Contributory negligence, you only have to prove that they were 1% responsible for the injuries, then they don't get paid. Comparative negligence is where most states use. Comparative negligence is where if they're 1% responsible, then the award amount, however much they win, is lowered. So like, let's say I was doing 110 and this guy was doing 75 and a 55. We're both at fault. We're both speeding. but they'd say I was 75% responsible, he was 25%, so he'd only get 75%. Comparative negligence is kind of like where you say, okay, look, it is my fault, but it's also his fault. This is how most lawsuits occur. So if you ever get accused of being negligent, you can try and use one of these defenses to either stop the lawsuit or to try and lower your chance of paying out. Contributory is completely blaming the victim, saying, look, man, it's your fault, not my fault. Comparative is where you both agree to share. Assumption is where you say, hey, you knew what was going on, so it's not my fault. Intervening cause is where, hey, I tried to fix it, but something stopped me. And then the statute of limitations is, hey, man, you waited too long to sue me, get out of here. So that's what you can use if somebody ever accuses you of being negligent. Now, there's different types of liability, 3 primary types. Absolute liability, if you ever go to court, is where you were doing something so dangerous that none of those defenses even work because you are 100% liable for the damage. So like if you're playing with fireworks and you blow off your hand, you can't sue the fireworks manufacturer because you knew fireworks were dangerous. It is absolutely dangerous. You're 100% liable. For some reason, your test uses a lion or a tiger. If your neighbor walks a pet tiger and the tiger or lion attacks somebody, the neighbor's at fault. He is 100% absolutely liable for that act. Absolute liability is where there's no real defense. Strict liability is product liability. This is what manufacturers get. Strict liability is where the product has to fail during its intended use. So for example, let's say you have a chair, and the chair has rollers. You sit in the chair falls, breaks, you're covered, everything's cool. Manufacturer covered. But let's say you decide to stand on the chair to change a light bulb. And then the chair moves and you fall. The manufacturer would say, it's not our fault. The chair worked like chairs do. You should have been standing on a chair that rolls. We're not covered. We're only strictly liable for the product if you use it in its intended use. So strict liability is product liability. Vicarious liability is where you shift the blame to a more responsible party. So like, let's say you have a child who's 7 years old, and they were playing baseball, and they hit a ball through a house window. You're not going to sue the child. You're not going to get any money from a kid. So you sue the kid's parents. The parents are vicariously liable for the actions of the child. This is why if you've ever had a job before and you messed up, you don't get sued. They sue the company. The company, the employer, is more responsible than the employee. So if an employee does something wrong, you don't sue them personally, you sue the actual employer. Vicarious liability shifts the blame upwards to the more responsible party. Absolute is absolutely dangerous. Strict liability is product liability, strictly for its intended use. Now, different policies have different ways of having limits. Split limit is most common in auto insurance. Split limit means you have different limits. The state minimum limit for auto insurance in Texas is 30, 60, 25. That means $30,000 per person, $60,000 per accident, $25,000 property damage. You have different limits for different things. That's personal auto insurance. Business auto uses combined single limit. Instead of having different limits for different areas, you just get one big limit and throw everything underneath that. It's like an umbrella policy. Combined single limit is what business auto uses. Split limit is what personal auto uses. You have different limits of liability. Commercial liability insurance, like business insurance, not auto, but like business liability, slip and fall coverage, uses something called aggregate. The most common business policy is 1 million, 2 million. That's 1 million per occurrence, 2 million aggregate. We cover this a little bit later on in the liability section, but if you have a claim of $250,000, that's definitely under the $1 million limit, but then it depletes the aggregate. So after you have this claim, you then have for the rest of the year 1 mil, 1.75 mil. Aggregate is kind of like having a storage bank. This is the max per one claim per occurrence. Aggregate's kind of like an extra limit that you can tap into. It depletes throughout the year. You'll learn more about that in the liability section of the learning course. Cancellation is sudden termination of a policy. Cancellation typically occurs if you don't pay your bill. Cancellation is when you get terminated right now. Sometimes they'll give you like 10 days notice, but cancellation is during the policy period. So like your policy is good for January 1st to December 31st. You don't pay your bill in May, you get canceled. Non-renewal is where they have to take you to the end of the year. Then they decide they don't want you next year. A lot of people get cancellation and non-renewal mixed up. In homeowners and auto insurance, they can only cancel you during the first 60 days for any reason. After that, you either have to not pay your bill or have committed fraud. So like a lot of people say, oh, I got in too many car accidents or I got too many speeding tickets. My insurance company canceled me. But that's wrong because they can't cancel you for that after this first 60 days. They actually got non-renewed. That means next time the insurance company said, we don't want you next year. Cancellation also occurs if you're caught driving on a suspended or revoked license because you're not legal to drive. Cancellation is the sudden termination, typically if you don't pay your bill. They can cancel a new home or auto anytime in the first 60 days because that's underwriting. They find something, they're like, I don't want it anymore. After 60 days, they have to keep you even if you have too many claims. Then they'll just non-renew you. The only reason they cancel you during the after the 60 days is if you don't pay your bill or you commit fraud or you violate the law. These definitions go by relatively quickly. They're strictly memorization. Risk is the uncertainty of loss. Every day you take a risk. You never know when you'll have a loss. There's two types of risk, pure risk and speculative risk. Pure risk is insurable. Speculative risk is not insurable. Speculative risk is when you have the chance for financial gain or financial loss. That's like gambling or playing in the stock market or real estate values. They change. We cannot insure somebody's gambling losses. Pure risk is insurable. It's when you have no chance for financial gain. If your house burns down, that is a pure risk because you don't actually make money when your house burns down. They just indemnify you back to where you were. Exposure is how prone you are to loss. So like men and women are differently exposed. Driving records are different exposures. Exposures are units of measurement. These are methods of risk management. If you have a risk, you can practice all of these. Avoidance is your best option. So like if you don't want to get in a car accident, don't drive. But how are you going to do anything? If you don't want to get in a plane accident, don't fly. But how are you going to get anywhere? Retention is when you retain some of the risk yourself. That's self-insuring. You get lower premiums if you have a higher deductible. Sharing is when you have multiple insurance companies. That was under the other insurance provision that we learned earlier. Reduction is like maintaining your home or body. Reduction is like checking up on your house every year. Putting in a burglar alarm. And then transfer of risk is insurance. Insurance is the transfer of risk. This is relatively low priority on the test. This is also another relatively low priority on the test. In order to insure something, the insurance companies have to follow these rules. Insurance cannot be mandatory, meaning there always has to be a way to get out of insurance. So like if you don't want car insurance, don't buy a car. Not practical, but insurance cannot be mandatory. Insurance companies do not cover catastrophic losses, so like we don't cover war or nuclear damage because that would bankrupt an insurance company. Insurance companies use the law of large numbers to have homogeneous risks. Insurance claims must have a definite time, place, and value. You can't insure something for forever, you can't insure something for everywhere, and you can't insure it for infinite. There has to actually be a definite time, place, and value. And insurance companies will never cover intentional losses. We do not insure intentional losses. In order to have an insurance contract, you have to meet these 4 metrics. A legal contract consists of offer and acceptance, consideration, competent parties, legal purpose. I'm going to start from the bottom and work my way up. All contracts have to follow the law. If it doesn't follow the law, it's not a legal contract. Everybody in the contract has to be competent. So you have to be of age, sane, and sober. You can't enter into a contract if you're a minor. You can't enter into a contract if you're drunk. You can't enter into a contract if you're crazy. So you have to be of age, sane, and sober in order to meet that metric. All contracts have to exchange money. Consideration is the exchange of monetary value. The insured exchanges their premium. The insurer promises to pay claims. There has to be consideration on both parts. We pay our premiums, the insurance company pays out our claims. Consideration is the money honey portion of the contract. All contracts also have to have offer and acceptance, meaning you have to agree. The customer, the applicant, offers themselves up to the insurance company by filling out their application. They say, please take me. The insurance company then decides whether to accept you. Then you exchange your money, then everybody makes sure you're not crazy, and then we make sure that it's a legal contract. Therefore, we've met all 4 metrics. On your test, they like to ask you the exchange of monetary value is found in which portion? Consideration. Which of the following best describes the offer? That's when the applicant fills out the application. When does acceptance occur? That's when the insurer accepts and approves an application. Then your test likes to say all of the following are parts of a contract except consideration, competent parties, legal purpose, and negotiation. Negotiation is not part of a contract. That's because insurance contracts are contracts of adhesion. A contract of adhesion has no negotiation. It's known as take it or leave it. The easy way to remember that is it's kind of like glue. You can't change it. If a contract of adhesion has ambiguous statements, then we rule it in favor of the customer. So this is the reason why when you quote people, they'll say, can't you get it cheaper? And you'll have to say, no, I'm sorry, this is not a negotiation. The rates are set by the insurance company. Glue, it's adhesion, we can't change that. Insurance contracts are also aleatory in nature. Aleatory is the exchange of unequal amount. So like if you have life insurance and you pay $10 a month, but you get $500,000 in coverage, that is aleatory. Aleatory is the exchange of unequal amounts. That's where the customer pays a little bit, but they're covered for a lot. Insurance contracts are also unilateral in nature. There's only one wheel on a unicycle, so therefore uni means one. The way I remember this is it's a unilateral contract. Unilateral contracts mean that only one party is obligated by law to uphold the contract. The insurance companies must follow all of the rules in the contract. You can cancel whenever you want, but they can't cancel you. So the insurer is required by law in a unilateral contract to follow it. A representation is a statement made on the application by the insured. When you ask the insured what their name is, and they say Joseph Miles, that's a representation. Representations we treat as if they're true, even if they're untrue. So for example, a lot of people call me Joe. So if you ask me what my name is and I say Joe, that would be a representation, even though my legal name is Joseph. Representations are sometimes not true, but we think they're true when we made them at the time. So for example, you might ask an insured, how many square feet is your house? And they might say 4,300. But then you pull it up on the taxation website and you find out that the house is actually 4,100 square feet. That's still a representation. The insurance company just fixes it and changes the policy to reflect the correct amount. A misrepresentation is a lie. Misrepresentations are intentionally untrue statements. That would be like you saying your house is 2,000 square feet when it was actually 4,100. And you knew you were lying, but you were trying to get lower insurance premiums. A lot of people misrepresent themselves in auto insurance through driving records, having too many speeding tickets, or having accidents. Misrepresentations, if they're material, can void the actual policy. So let's say you ask an insured, have you had any accidents in the past 3 years? And they say no. We treat that as a representation. But then we pull their motor vehicle record and their clue report showing their accident, and we find out that they've had 6 at-fault accidents in the past 12 months. That's a lot of accidents. The insurance company would void any coverage if they found out that you made a material misrepresentation, because nobody wants to insure somebody with 6 accidents in 12 months. So representations are true. We treat them as if they're true. Misrepresentations are untrue. If it's material, meaning that it would change the outcome of the policy, the insurance company can void that policy. Now let's say, for example, you're driving your car and you get into an auto accident and you hit your head. So you now have amnesia. Tomorrow, you try to buy insurance, and they ask you, have you ever had any speeding tickets? Remember, you have amnesia, you can't remember anything, so you say, no, I've never had any speeding tickets. If they then look up your MVR, motor vehicle record, and find out that you had a speeding ticket 6 months ago, we'd still treat that as a representation, because remember, you have amnesia. You don't know that you had a speeding ticket 6 months ago. So these are very subjective terms depending on what the customer knew when they were applying. If you knew about it up front and you lied about it, that would be a misrepresentation. But if you didn't know about it and you didn't know you were lying, that's just a representation. So representations are true to the best of your knowledge. Misrepresentations are intentionally untrue statements. Material misrepresentations can void a policy. Concealment is another part of misrepresentation. You can say all concealments are misrepresentations, but not all misrepresentations are concealments. Concealment is when you just don't say something. So you're going to insure people's houses and you're supposed to go out and take pictures of their homes. If the customer doesn't come up front with anything that's wrong with their house, that would be a concealment. That's when you withhold or hide information, hoping nobody finds out. So for example, let's say you write homeowners insurance and you ask, have you had any claims? And they say no. So you continue through. Then you get out and you take pictures of the house a week later. And you find out that the roof has all of this hail damage on it. You'll call the customer up and say, hey man, I thought you said you never had a claim. They would say, well, I've never filed a claim on that. but they still concealed the fact that there was damage to their house. They knew what you were asking up front. Concealment is when you withhold information or you hide information. It's when you're not forthcoming. Misrepresentations are lies. Representations are statements on an application. The next word we have is a warranty. Warranties are guaranteed to be true, and they will remain true the entire time. Warranties are literally true, guaranteed statements that are absolutely true. An example of a warranty would be saying that you have a burglar alarm. That is going to be a guaranteed to be true statement, and you can get a discount on your homeowner's policy. So let's say you get the discount for the burglar alarm, everything's cool. Then next year, you cancel your burglar alarm and you uninstall it. You have now breached that warranty. You first told them, hey, I have a burglar alarm. Then later on, you removed the burglar alarm, but never told the insurance company. A breach of warranty can also void coverage as well. Most applicants do not make warranties because you can't say most things are guaranteed to be true. You can say, today I have a burglar alarm, but if you guarantee that you're going to have that burglar alarm, that would be a warranty. And if you breach that warranty, that also voids coverage. These terminology will be on your test. Pretty much every test has some questions on representations, misrepresentations, concealment, and warranty. Representations are statements on an application. Misrepresentations are lies. Material misrepresentations are big lies. Concealment is withholding information, and warranty is a guaranteed, literally true statement. There is no question as to whether or not it's true or not. The next word that we have is fraud. Fraud is also similar to material misrepresentations. But with fraud, you have to be going for financial gain. So like if you lie about your square footage on your house, that's a material misrepresentation. But if you lie about having a claim and then you get paid for that claim, that's fraud. Fraud is the willful and intentional act for financial gain. That's like embezzlement, which is stealing, or filing false claims, or lying about your claims, or padding claims. Pretty much any time you're lying to get money, that is going to be fraud. You can be fined a maximum of $50,000 per act of fraud, and you can go to jail for 10 years for each time you commit insurance fraud. Insurance fraud is a felony, and as an agent, you won't deal with this too much, but if something seems a little fishy, definitely tell your insurance company, because fraud hurts the entire insurance industry. If a customer gets too much on a claim, or they file a false claim and they get paid, well, we all have to pay higher premiums for that. Waiver and estoppel is a relatively difficult concept. A waiver is when you give up a right. And if you give up a right, you are then estopped from taking that right back. So I'll give you an example. In a homeowner's policy, in order to cancel you for non-payment, the insurance company has to give you 10 days notice. So let's say you have homeowner's insurance, you don't pay your bill, they send you a letter and say, hey, your bill's due within these 10 days or we cancel you. You call up your insurance company and say, look, I don't get paid until 15 days from now. Then I can pay you. If the insurance company says, okay, we'll accept premium in 15 days instead of the original 10, which they would never do, they have then created a waiver. They have said, you no longer have to pay in the correct 10 days. We'll give you an extra 5 days, up to 15. So we have waived the right for 10. If you file a claim on day 11 through 15 and you didn't pay your bill, you are covered. because the insurance company would be stopped from going back to the right that they had given up. A waiver is giving up a known right in a policy. The insurance companies almost never do this. And if they do give up that right, then they are stopped from taking back that right. On your test, these are primarily just definition. It'll say giving up a known right in a policy is best described as what? Waiver. And when the insurance company can no longer take back that right, that is known as what? Estoppel. The Fair Credit Reporting Act allows the insurance companies to pull credit reports, motor vehicle reports, do physical inspections, and other underwriting on the customers. The Fair Credit Reporting Act is a federal law that went into effect in 1971. It applies to every state. The insurance companies pull people's credit through the credit reporting agencies, also known as credit rating agencies, which are Experian, TransUnion, Equifax, LexisNexis. There's quite a few of them, but I went through the most common ones. When the insurance companies pull a person's credit report for underwriting, we do something called a consumer report. It's a soft pull of credit where they just check to see if a person pays their bill on time, checks their motor vehicle records, and things like that. We have to notify people up front that we are pulling their credit. And if their insurance premiums go up because of their credit report, the insurance company has to send them a letter within 5 days explaining why their premiums went up. The Fair Credit Reporting Act also allows insurance companies to do investigative consumer reports, which are much more in-depth than a regular consumer report. This is where the insurance companies take pictures of homes or sometimes ask that you cut the tree branch so it doesn't fall onto your house. The investigative consumer report is typically outsourced to a third-party company, and they'll do inspection reports, and they're very detailed. They can be up to 20 pages long. When we notify people up front that we're pulling their credit, they do not have to sign anything. We just say, hey, what's your social? They'll say, why? And then we'll say, we're going to check your credit, but it's just a soft pull. This does not harm your credit score. If you do not tell people that you're pulling their credit, the agent, you, can be fined up to $2,500 if you continue to violate the Fair Credit Reporting Act over and over. So it's very important to make sure that you read the statement that the insurance companies tell you to when we pull people's credit. It's usually 1 or 2 sentences. If there's incorrect information on a person's credit report, the insurance companies must have a method of dealing with that incorrect information. We all know that if there's something wrong on a credit report, you can dispute it through the mail. At TSI Training, we also have a credit repair course that you can purchase if you would like, that we teach people how to dispute things off their credit report. And that way you know the proper way. But that's a whole different course. When the insurance companies do these credit reports, the underwriter will see it. Sometimes they'll send it down to the agent so we can explain it to the customer. But we never send these credit reports to the Department of Insurance. The Department of Insurance was the regulatory body that handles insurance matters. They don't check people's credit. That's the insurance company's job, the underwriter and the producer's job. If we ever do send information to the Department of Insurance, we have to remove all personal information. That would only happen if there was an inquiry on insurance fraud or something like that, where stolen identity. So I want to run through this very quickly again. The Fair Credit Reporting Act allows the insurance companies to do underwriting and pull people's credit. There's a consumer report and an investigative consumer report. We must notify people if we're pulling their credit. If their premiums go up, the insurance company has to send them a letter within 5 days. We have to notify people at the time of application that we're pulling their credit, and if there's incorrect information, there must be a method, which we know is disputing. The Department of Insurance never sees the insurance Consumer Reports. This was a very long chapter, and it had a lot of definitions in it. This chapter, like I said, was very important to passing your test. These definitions will be on every test. But anyway, good luck studying, and I'll see you into the next chapter.